Good afternoon, everyone, and thank you for joining us today for the CAAT Pension Purchase webinar for members of the Catholic Charities of the Archdiocese of Toronto. My name is Bill Hurley, and I will be the moderator for today's session. Presenting the webinar today is Steve Hyland, and assisting Steve would be Andrea King with any questions that you may have on the presentation. So thanks for joining us today, and now I'd like to pass it over to Ganesh from Catholic Charities to begin today's webinar.
Good afternoon, everyone. This is Ganesh Subramaniam of Catholic Charities. I welcome you all for this very important seminar on purchasing additional benefits. As you may know, when joining the CAAT pension plan effective January 1st of this year, we have enhanced the Catholic Charities members' pension by increasing the multiplier of the pension plan and introducing the final average earnings, as well as enhancing the past pension by 2.25%. In addition to this, your pension is increased by while you are employed by the average industrial wage and cost of 75% of the CPI as well. So as a result, we have increased the pension of every member. Now they are going to explain us and walk us through how we can increase the pension from other plans. So there are two ways. While we were employed by Catholic Charities and member agencies, there may have been some qualifying periods or waiting periods during which you may not have earned the pension, as well as when you were employed by other employers, you may have contributed a registered plan, but that may not have the enhancing factors like the IBF details. So I'll pass on to Steve, who's going to give us demonstrate us how we can earn more pension.
All right, thank you very much, Ganesh. I'd also like to welcome everyone who's taken the time out of their busy day to join us for today's webinar. What we're going to be focusing on today is purchasing additional pension in the CAAT pension plan. Okay, more specifically in DBplus. So before we get going, I'll kind of introduce myself. What I do at CAAT, I'm the lead of growth pension education, and I've been with CAAT for about 6.5 years now. And a big part of my job at CAAT is education and training. So I train specifically new members and employers who are coming into CAAT. So pretty much we talk about everything pension. So DBplus is our focus today, because everyone in the Catholic Charities is going into this pension plan design. And yes, it is specifically for those who work for the Catholic Charities. And as of January 1, 2020, started to contribute to DBplus. Okay, which means you started earning or accruing a DBplus pension under the CAAT plan. So, and everyone listening in will continue to earn that pension right up until your retirement date. So again, we're focusing on the option to increase your pension even more if you choose to do so. So I'm very pleased to talk to you about pension purchases here today. All right, so today what our objectives are is to describe this option that's available to you to purchase additional pension in DBplus. Remember, there is no requirement to elect this option as the CAAT. As a CAAT pension plan member, you now own that decision on whether or not you'd like to make a purchase. So the choice is yours. It has no negative impact on the regular pension that you earn as a DBplus member. In fact, it will only increase your pension average. But keep in mind, once you go through the process, the funds to purchase additional pension, they must come from a registered tax-sheltered vehicle. Okay, so for example, funds in your Catholic Charities DC account may be used. You may use funds from your group RSP if that applies to you. But keep in mind, if you are interested in purchasing more pension, have the intention of using your DC account balance from your previous Catholic Charities pension, that plan will need to be wound up first, and then you will receive the option to do that. So you will have to wait before this happens, and it is anticipated to happen probably sometime early this year. So this is our agenda, or outline for today. And to start off, what we're going to do is we're going to give you a little bit of a recap or a refresher of your pension plan design called DBplus. So we'll look at the pension formula to understand how we calculate your pension or how you earn a pension year over year. But once we get into the meat and potatoes of this webinar, we're going to describe what pension purchases are. We're going to talk about various types of purchases that you can make. So most importantly, we'll discuss how much pension you will get. Okay, so there is a formula that's used as well for pension purchases, and we're going to go through it in depth. And the most exciting part of this webinar, at least in my opinion, is that we're actually going to go through a demonstration. So at CAAT, we have a number of tools that you can use on the DBplus website. We have a relatively new purchase tool, and I find this really resonates with most of our membership once we go through a demo of this tool. Most members find that it's extremely helpful because this is how you start the process of purchasing pension. We're also going to talk about the consideration for purchasing additional pension. In other words, what you need to consider because the choice is yours. Because pension purchases, they aren't for everyone, right? It may make sense for one individual to make a purchase, but for someone else, it may not make sense. So it's also important to understand the rules for pension purchases. Okay, so we're going to go over some of those. We're going to talk about the maximum of 18%. And then finally, we're going to end off with the process for purchasing. It's a very, very straightforward process. You start it off by running an estimate, and then you can print a form from there. You hand that form to your employer, and that gets sent to CAAT, and we'll do the calculation for you. All right, so let's get going. So just to provide you with a little bit of a refresher, there was a merger between the Catholic Charities and the CAAT pension plan. So just as a recap, as of December 31, 2019, members in the Catholic Charities and defined benefit pension plans, so both the defined benefit pension plan and the defined contribution plan, and even the group RSP, they ceased contributions and they started to contribute to the CAAT plan in DBplus. And now you're accruing that new pension under CAAT. Okay. For those that were in the DC plan, again, remember you can and you will be able to use your DC account balance to purchase more pension. Okay, but again, in order for this to happen, that plan does need to be wound up first. Okay. Effective January 1, 2020, any new full-time members who are not participating in any of the Catholic Charities retirement arrangements, they can now enroll in DBplus. Okay, and part-time employees who join on or after January 1, 2020, they have the option to enroll. So full-time employees will enroll in DBplus automatically, and part-timers have the choice. So these new members who are coming in, they may have some time to, that they wish to purchase. So for example, let's say they worked somewhere in the past for another employer that had a registered pension plan, they may be able to purchase more pension in DBplus as well. So a lot of different options that we're going to talk about. Belonging to the CAAT plan gives you that sense of income security in retirement. That's simply because DBplus is what's called a defined benefit pension plan, which means your benefit at retirement is defined. So we know what it's going to be because it's based on a set formula. And that DBplus formula is the same for everyone listening in. We're going to walk you through an example and show you how we calculate your pension. But with DBplus, you're going to earn a predictable and a secure pension that's payable for life. Predictable because, again, your pension is going to be based on a set formula, and secure simply because your pension is going to be backed by a multi-employer pension plan such as CAAT. Now, there are conditional enhancements in DBplus that you're going to earn during your working lifetime and also in retirement. And also, not only does CAAT have generous early retirement benefits, but we also have survivor benefits as well, meaning, where does the pension go in the event of your passing? So the CAAT pension plan does have valuable features or provisions under DBplus. The contributions will be matched by your employer, the Catholic Charities, and each dollar contributed will increase your pension. So contributions are a major component of the plan formula, which you're going to see in just a moment. And those contributions are tax deductible. What that means is that they are subject to the ITA, or the Income Tax Act. So very, very similar to RRSP contribution. Those deductions come off your paycheck before any other deductions come off, like CPP, EI, and things of that nature. But let's talk about how you earn a pension at the CAAT plan. So here, what you're looking at is the pension formula. This is how we turn those contributions into an annual pension. So as you can see here, there are two parts to it. So we're going to start off with part number 1. That's the top part in blue. All we simply do here is we take the total contributions, meaning the employee contributions and the employer contributions, and we multiply them by an annual pension factor of 8.5%. Okay, so that 8.5% is the DBplus annual pension factor, and this part of the formula is used to calculate your guaranteed base pension. And every year, as a member, you're going to have a guaranteed base year over year. Now, in addition to that, if you look at number 2 here, these are enhancements to pensions already earned. Okay, so what does that mean? So these conditional enhancements, we take the total pension that you've earned in your previous year and we multiply it by what's called the AIW enhancement rate. We love acronyms in the pension world. AIW stands for average industrial wage. It's the measure in which wages increase in Canada year over year. I'll give you an example here. Let's say the AIW one year was 2.7%. We would use that rate in effect to increase your pension while you're working. So this is done behind the scenes. It's a part of the plan formula. Okay, so we'll take that AIW rate and multiply it by your previous pension in your previous year, and that will help grow your pension while you're working. So I like to refer to this as pre-retirement indexing. While you're working and contributing, yes, your pension. And of course, it is dependent on what AIW is year over year. And the average over the last 20 years is around 2.2%. And that's what we use in the majority of our examples that you'll see throughout the webinar today. So part 1 and part 2. So let's go through an example. Hopefully this will give you a better understanding of how we calculate pension and how you would accrue a pension year over year in DBplus. So I'd like to introduce you to Sara. She's 30 years old. She has earnings of $50,000 and her earnings increase at 2% per year. And the contribution rate that we're using for the purposes of this example is 7%. So that would mean she's contributing 7% and the employer would be matching as well. So a total of 14% contributions. So the math is very, very straightforward. We're taking the 7% contribution rate, multiplying it by her earnings of $50,000. That equals $3,500. Remember, the employer is going to match that exact amount, $3,500 as well. And now we're going to total that up for a total of $7,000. Those are the total contributions. And then we'll multiply that by our annual pension factor. Okay, so Sara, in year 1, she's going to earn an annual pension of $595. There's the $595 when she's 30 years old. Okay. Now in year 2, when she's 31, because of that little earnings increase, you can see she's going to accrue a pension of $607. Okay, so it slightly goes up. But now what we're going to do is we're going to take the pension earned in the previous year and stack that on top. So now we got the $595 and the $607, and we won't stop there. Now is where we add AIW. Okay, so we're going to take the pension earned in the previous year, that $595. Okay, we're going to add AIW to that, which is $13, and then we'll total everything up. So in year 2, Sara will earn an annual pension of $1,215. Now, although AIW is conditional on the plan being strong, once it's granted, it can never be taken away. Okay, so very, very important to understand that. Once it is granted, it forms a part of your guaranteed base, and we can never go back and take that AIW away from any members whatsoever. Now in year 3, the same concept applies. Everything gets compounded now. This is where things get really interesting. Okay, so in year 3, the earnings go up, obviously, by that 2%. So there's the $619 at the bottom when she's 32. But now we're bringing the entire $1,215 over. And we're going to add AIW to that total amount. So the idea of compounding here comes into play. So you can see AIW is going to increase year over year because it gets added to the previous year's pension. Okay, so we're taking the $619, the $1,215, $1,215, and the $27 of AIW sitting on top for a total of $1,861. So this is how Sarah's going to build her pension each year. Now, what if she wants to look at, what is she going to build up until age 65? So assuming that Sarah retires at normal retirement age, this is age 65, you can see here we have our guaranteed base pension, so that's in dark blue at the bottom. Okay, and we also have the AIW enhancements that are sitting on top. Okay, and you can see how they really start to add up through Sarah's working life. In fact, over the whole period of about 35 years between ages 30 and 65, AIW can add almost 42% to her pension. Okay, so, and you can see we've also shown it separately here just so you can easily see how it adds to her pension. And finally, at the end, you can see over this 35-year period, at age 65, you can see what she has contributed to the plan or to DBplus. She's contributed $175,000 to DBplus. It's also important to realize we have included an assumption in this example. It's the little box in the bottom right-hand corner of the screen. We use an assumption with regards to our annual pension factor. This is great news, by the way. It is anticipated to increase to 9.5% by 2023. And that's simply because the plan fund is very, very healthy. We have been trending up over the years. We are guided by what's called our funding policy here at the CAAT pension plan. And all this means that, in the next couple of years, anyone who belongs into DBplus, it's only going to increase their pension because that annual pension factor is a major driver of our members' guaranteed base pension. Now, let's look at her expected pension payments in retirement. Okay, and for the purposes of this example, we've assumed that Sarah is going to live right up until age 90. Which we consider as a reasonable expectation of life for anyone who retires from the age of 65. So Sarah's 35 years of contributions, you can see, are kind of smashed there to the left-hand side between ages 30 and 65. But now you can see her pension starts at age 65. And it starts at around, I would say, $47,000 per year or annually. And when it does, her pension doesn't stop building. It's also going to grow in retirement with conditional inflation enhancements. Okay, otherwise known as post-retirement indexing. Now, at the CAAT pension plan, inflation is paid at 75% of the consumer price index or the CPI. All that means is that, let's say, inflation 1 year is 4%, then we would pay it at 3%. If it's 2%, we pay it at 1.5%. Okay, that's that little increase you get once you're retired. So it's like a little salary increase. And we've shown them here sitting on top of the guaranteed lifetime pension. Okay, so although her pension starts at around $47,000, by the time she's reached age 90, her pension has grown to around, I would say, $68,000 per year. And this is all due to those inflation protection increases. Okay, so a couple of other things to mention here. You can just see how valuable AIW enhancements are during her working life and how much additional pension inflation adjustments can bring after retirement. Okay, a couple of other things to note is that when we mentioned the contributions that she's put in, was around $175,000, which is a large chunk of change. You can see here that by age 69, Sara would have already recovered everything she's paid in. Okay, and this is indicated by that dotted line that you see here on the screen. Okay, and that's in fact why CAAT has what's called a guaranteed 5-year payment period. Okay, so from a member's perspective, you're never going to get anything less out of the plan than what you paid in. And another takeaway is that there's a very quick return in retirement on what you paid in. All right, so that's just a little bit of a recap of how you're building a pension year over year, the CAAT plan. Now we're going to get into DBplus pension purchases. So first and foremost, what is a pension purchase? So your DB pension from the CAAT plan, really it's the cornerstone of your retirement income. It will provide you with a lifetime of monthly pension payments after you retire. Okay, so a DBplus pension purchase, it's really an effective way to maximize this lifetime retirement income from one secure source. So it may be worth it for you to consider a DBplus pension purchase. So there are two categories of pension purchases, breaks in employment and periods of employment before enrolling. A break in employment would include any unpaid leave of absence that was approved by your employer or let's say maybe a statutory leave, such as a pregnancy or parental leave. Now, if there are any periods where you had one of these types of breaks in employment while you were a participating member of the CAAT plan, then you can purchase any or all of these periods to increase your pension. It could also mean a period of employment before enrolling. So that could include any period of time that you work for a CAAT participating employer before joining the CAAT plan. So for example, let's say you were hired as a part-time employee on June 1st, 2020, and then you decided to join the plan on January 1st, 2021. You can purchase that period from June 1, 2020 to December 31st, 2020, if you desire. Okay, so that choice is yours, but that's what we mean. Next, if you had a prior period of membership in the CAAT plan, meaning once upon a time in the past, you worked for a CAAT participating employer, and you were a member of the plan during that time, and let's say you cashed out or you transferred out your benefit when you left, and now you found yourself back, you rejoined the plan, you can now purchase that period of employment as well. So that's another option that you can purchase. And finally, you may have participated in a previous employer's pension plan. If that's the case, it does need to be a Canadian registered pension plan or an RPP, and then you can purchase that period of employment in the CAAT plan. Okay, and we do have an example for this specific one as well, and we're going to illustrate that a little bit later on in the webinar. So now, although the option of purchasing pension is not for everyone, there are a number of benefits to purchasing pension in DBplus. So first, the pension purchase results in a higher lifetime pension in retirement. Okay, and that's the ultimate goal. You want to increase that pension, and a pension purchase is a great way to do that. Next, the pension that you purchase becomes part of your guaranteed pension. Okay, so it is treated the same way as the benefit you are earning through regular contributions while you're working. So this means that the pension that you purchase will continue to grow as you continue working and contributing to DBplus while it receives those AIW increases. So you will get more AIW increases. The pension you purchase also includes the same conditional inflation protection and no-cost survivor benefits as the rest of your pension. So this is also very, very important. Once you're credited with a pension, okay, it's calculated, you're credited with the purchase amount of pension. It will grow with AIW, it will grow with inflation, it will increase your pension, which means ultimately increases that survivor benefit as well. And a pension purchase is simply a great way to consolidate all of your retirement savings. So this is an idea that most people do enjoy, consolidating all their retirement savings under one pension plan. A pension purchase is a great way to do that. And lastly, your defined benefit pension from CAAT is a guaranteed stream of lifetime pension payments, okay, in retirement. So you can never outlive your pension. So by purchasing pension, you are increasing this guaranteed stream of payments that you will receive for as long as you live. So how much pension will I get? Now, first off, we would never ask anyone to calculate these purchases on their own, which is why we have some excellent pension estimator tools on our DBplus website, and it is available for all Catholic Charities members. These tools will obviously help you in making those better informed decisions with regards to your particular purchase. Okay, but before we demo our tools, I did promise we're going to do a little demo. Let's look at how we calculate these purchases. So in DBplus, purchases are treated like contributions. First, you make a contribution for the period that you're purchasing, okay? And the purchase contributions are then multiplied by the annual pension factor. Again, remember, it's 8.5%. And this comes directly from the DBplus plan formula, which we saw earlier. And lastly, what we're going to do is we're going to multiply this by what's called the purchase adjustment factor. Okay, the purchase adjustment factor depends on your years from normal retirement, which is the end of the month. You reach age 65, okay, and that's at the date of purchase. So in other words, how far are you away from age 65 when you make that purchase? And this is an important general rule of thumb when it comes to purchasing pension. It simply means that the closer you are to your normal retirement age, the less pension your purchase will result in. Okay, so conversely, Okay, the younger you are, the more advantageous it may be for you if you're looking at possibly purchasing more pension. So the result is the annual pension that you have purchased. Okay, so always try to keep in mind this general rule of thumb when it comes to purchasing, that the younger you are, the more advantageous it is for you because you can purchase more pension because of that purchase adjustment factor. So the maximum amount that you can contribute from a purchase is limited by the ITA. Okay, so this is a very, very important rule. There are maximums set by the Income Tax Act, and the amount that you can contribute for a purchase is 18% of your T4 earnings in respect of the period. Okay, so for the applicable period or the amount of the funds in your registered retirement savings account, whichever one is lower. So the contribution that you make to purchase pension, it must come from a registered account. So for example, RRSPs, okay, or it could come from Malira as well. So let's look at an example here. So let's assume Sara worked for another employer in the past, other than Catholic Charities, okay, and they had a registered pension plan. Okay, and let's say Sara worked for them from 2015 to 2019, so for a period of 5 years. To calculate this maximum amount that she can purchase, we're going to take the total earnings in respect of the period, and we're going to total them up. So in this case, her total earnings from 2015 to 2019 are $267,500. Multiplied by 18%, $48,150. This is the maximum that Sara may transfer in if she's looking at a pension purchase. Okay. And again, you're not going to have to calculate this maximum on your own. The purchase tool will do this for you. So I mentioned earlier that the closer you are to normal retirement age, the less pension that you can purchase, meaning the younger you are, the more beneficial it is to you, the more pension you can purchase. This is very, very important to realize. And this is simply because the purchase adjustment factor, it depends on the number of years you are away from your normal retirement date, okay, which is the end of the month you turn 65. If you make your purchase when you're more than 25 years away from your normal retirement date, so for example, if you're 40 years old or younger, then the purchase adjustment factor is 100%. So what that means is that it would not factor in the calculation. It's like the purchase adjustment factor wasn't there. But if you are less than 25 years away from your normal retirement date, the 100% purchase adjustment factor, what happens is it's now decreased by 1.4% per year. And that's calculated on a day-to-day basis. Okay, so really another way of saying that is the purchase adjustment factor. It's going to factor in if you're 41 or older. So keep in mind, again, the decrease of 1.4% per year between ages 41 and 65. And by the way, at 65, the purchase adjustment factor is 65%. So let's look at some illustrative examples, and hopefully this will help clarify this general rule of thumb that we've been talking about. So the great thing about this chart is that it shows you how much more a member can purchase based on your age. So let's start off by looking at a member who's 40 years old and wishes to purchase pension. So let's say his contribution is $40,000. That's the first column we're looking at here under A. Then if you remember the formula, it's A times B times C, where A equals the purchase contributions, B equals the annual pension factor, and C is the purchase adjustment factor. But you can see here that for someone who's age 40, the purchase adjustment factor is 100%. So this person would be credited with $3,400 at the time of the purchase. But now you can also see in the second to last column, after AIW growth, this pension payable at 65 would be $5,858. Okay, so remember, AIW will factor in over the years. And something else to consider is the total retirement payout, which is in the last column at the right there. The total retirement payout for this person, let's say if they live till age 90, it would be $176,100. And if you compare these numbers to someone who's 60, so now let's compare that to the row for 60-year-old, the purchase adjustment factor decreases. So this member's pension credited at purchase is a little less than the 2,448 based on a factor of 72%. Okay, so you can see a 60-year-old is credited with $2,448. So the bottom line here is, yes, age factors in when we're talking about pension purchases. All right, so now what we're going to do a little bit of a demo of the pension purchase tool. So we'll just get out of here. So this is the DBplus website. To access the tool, you would simply go to My Workplace Offers DBplus, and you'll be greeted with the homepage. If you haven't visited our website, I'd highly recommend that you do. There's a number of tools that you can use on this website. There's lots and lots of information. You can access forms, you can plan for your retirement, and you could, even get some employer resources. So if you go under About Your DBplus Pension, if you click Making a Pension Purchase, this is how you can get started. So this page is strictly dedicated to increasing your pension by making a purchase. If you scroll down, we even have a little video that you can watch to help you make that decision on whether or not a purchase is right for you. Now, to access the tool, this is where you would access it, the DBplus Purchase Tool. And as I said earlier, it's relatively new, but it's a great tool because it does factor in the 18% maximum. So this is how you get started. So you'll be met with the drop down here. You simply click the employer that you work for, Catholic Charities. Scroll down. We always highly recommend that you read and understand the terms of use before you get going, and then you can click Start. And now you can get going. So this is where you need to input some information, and remember, it's only as good as the data that you input into our estimator tool. So you want to make sure it's as accurate as possible. So the first thing that it asks is for you to enter your date of birth. So by clicking on this here, let's say we're using someone from 1980, so that would mean someone who's 40 years old. We'll just use April 1st. And now you need to enter the period for which you need to make a purchase. So what we're referring to here is, let's say you did work for somewhere in the past, you need to break it down by year. So whatever the start of that period was, and whatever the end of that period was. So let's say you worked somewhere in the past. Let's go back to say 2017, January 1st, and let's say the end of the period is, let's say 2019. Let's use December 31st. Okay, so that period covers 3 full years. Now you do need to enter your T4 earnings for each year in this particular period. Okay, so in 2017, let's say you had $49,000 in earnings. That's where you want to enter it there. For 2018, let's say your earnings increased slightly. And then in 2019, let's say you had earnings of $50,000. This is important because this drives the estimate in terms of the maximum amounts in which you can purchase. Now you click Calculate. And there you go. So here you can see what it spits out is the annual purchase pension, assuming a purchase date of today, March 5th. So this is what the member would be credited with at their base. Okay, but before we get to this amount, this is assuming that the member contributed, their purchase contributions was $26,730. So this little calculation that's done behind the scenes, this factors in the 18% maximum from the ITA. Okay, so you cannot purchase more than $26,730. Okay, so that's what this amount is going to get this individual. Okay, here it factors in AIW. Okay, because this is credited at the base, and then over the years to age 65, we factor in those AIW increases as well for an annual pension of $3,914. Okay, that's the annual pension at age 65. Now, let's say you don't have $26,730. What you have the ability to do here, let's say you only have $20,000. You can change that number here on the left-hand side. Again, this is your purchase contributions. Click Calculate, and now these numbers will change. Here's your purchase pension amount. Because you're giving a little bit less, this will obviously go down to $1,700, and we're also factoring AIW. So at age 65, this is what that purchase amount is going to give this particular member, $2,929. Okay, so it's important to realize this amount is for the purchase only. This would be added to your DBplus pension, okay, that you also are earning currently, right up until age 65. Here's a detailed explanation of the calculation. Okay, before we get to that, again, if you have anything that you want to change, this is your basic information here: date of birth, start of the period, end of the period. Here's the earnings that we input. This detailed explanation provides you with the estimated DBplus purchase pension. There it is, $1,700. Here's the AIW increases and all the other information that you've input. Now, the most important part of this estimate, if you scroll down, is do you wish to proceed with the purchase? So at this point, you're not really committed to anything, but the first step in the process is running an estimate, as we have just done. The second step, if you are interested in doing so, this is where you can download the purchase application form. Okay, so there are different scenarios that are outlined. For this one in particular, I was a member of the Canadian Registered Pension Plan before joining the CAAT plan. Okay, if we're looking at that one, we would download the form here. I work for an employer that participates in the CAAT plan before joining CAAT. Okay, or I have funds in a registered retirement tax sheltered retirement account related to a period of employment with an employer that participates in the CAAT pension. So once you click this form, I'll just quickly show you the form. This is what it looks like. This is the purchase application form. This is what you want to fill out. So there's some member information, personal information here. You want to hand this to your employer. The employer will sign this form off and send it to the CAAT pension plan. Once it's sent to us, we will do those calculations and send you a formal estimate. And only at that point would you make your decision on whether you'd like to make a purchase. Okay, so you can see it's very, very straightforward, easy to use. Hopefully this will, I just want to encourage use because we have a lot of tools that are very self-serving. We also have the pension estimator tool where you can estimate what your pension is going to look like as well, but this is our purchase tool. Let's get back to the presentation. So let's look at some considerations and tools that you can use to decide whether a pension purchase is right for you. So first of all, what's your comfort level with investing? So are you comfortable with the risks of investing your lump sum savings yourself and ensuring a secure retirement? Or would you prefer the certainty of a guaranteed lifetime pension paid to you every month without having to worry about investments or those complex investment decisions that you may have to make? So what do you expect your retirement lifestyle to be like? This is another consideration. So in other words, will you have a lot of variable expenses during retirement? So maybe home renovations or weddings to pay for, where you might want to have more money in your RSPs that you can draw from at any time. Or will your expenses be fairly predictable and manageable in retirement? Okay, so for example, you're going to get a regular stream of income that would work for you. You want to think about your other sources of retirement income as well. So do you have any other investments or any other pension plan memberships that will supply you with retirement income? Or you need to think about your estate planning as well. Okay, so do your current retirement accounts include no-cost survivor benefits, or would your spouse benefit from having a regular survivor income after you're gone, such as the one provided by your DBplus pension? Okay, so keep in mind that a pension purchase is an important financial decision. You may want to see an independent financial advisor before you make your decision. So another factor which you may need to consider is the timing of a pension purchase. Okay, specifically as it relates to leave periods. So as we saw earlier, the plan calculates the amount of pension you would receive as a result of the purchase using your guaranteed-based pension formula and the purchase adjustment factor. Now, if you've gone on a leave, then you can purchase this break in employment after you've returned to work. Okay, so the 6-month mark is an important milestone in determining how much pension your contribution can purchase. So if you make the purchase within 6 months after you return to work, the amount of the pension you're going to receive is calculated with a purchase adjustment factor of 100%. Okay, no matter how close you are to the normal retirement date. So this is the same as having no purchase adjustment factor at all. So generally speaking, if you make a purchase within 6 months, okay, your contributions will result in more pension being purchased. Again, because your age won't factor in the calculation. Also, for certain types of leaves of absences that are protected under the ESA, the Employment Standards Act, so let's say a mat leave, for example, the purchase is also matched by your employer. Okay. If you happen to make the purchase more than 6 months after you return to work, the amount of pension that you receive is calculating using the purchase adjustment factor based on how close you are to normal retirement date, and that would be age 65. So in other words, you're going to pay the entire amount of the purchase, including the purchase adjustment factor. So that 6-month mark is a very, very important milestone. So under DBplus, members may have the option of purchasing additional pension in respect of the prior employment. You can purchase periods of employment with a participating employer that are not credited under their plan. Okay, and you can also purchase periods of employment with a non-participating employer that are credited under its registered pension plan. Okay, you cannot purchase pension from another employer's pension plan if it was earned in a DB pension before 1992 and the funds are still in that original plan. Okay, and in a general sense, a member cannot purchase any pension for periods before 1991. And if you're ever unsure, you do have questions on this or on these particular dates, please feel free to call us directly or at any time. So again, we want to remember that the money must come from a registered tax sheltered vehicle. So it could be RRSPs, it could be a defined contribution pension, it could be a deferred profit sharing plan. The funds cannot come from any after-tax vehicle. So for example, it cannot be funds from your bank account or any after-tax investments. Okay, so again, this is another very, very important piece or another important general rule of thumb. So do you remember Sara? So here Sara is, we went through an example before. We walked through her example on how her pension builds year over year. Now let's say Sara wanted to purchase more pension in DBplus. So if we remember, she was about 30 years old, she had $50,000 in earnings, and she had a pension of about $47,500 per year, and that was at age 65. Now let's say she wanted to purchase pension and she had a contribution of $40,000 that she wanted to make. Let's say she had RSPs to use, and she's using this for a period of employment that she had with Catholic Charities. So let's have a quick look at the impact here. So this is the graph that we previously saw for Sara. You can see the purchase pension. That's that little kink in the graph early on when she makes the purchase. You can see how it increases her pension at the outset. And then you can also see the AIW increase. Because of that increase in purchase pension, the AIW is going to add 47% to Sara's pension. So at age 65, as a result of this purchase, she's going to have an annual pension of $55,000 approximately, where previously it was $47,500. So quite a significant increase. The difference per month is about $625 per month. And remember, that is a lifetime pension. So if you were to live until 105, that's a check at the beginning of each month for the rest of your life. The process is very, very straightforward. You saw we went through the estimator tool. That is step one. So the first thing you want to do is jump on our tools, produce an estimate, and then you want to submit your pension purchase application form to your employer. Okay? And then they're going to fill it out, sign it, get it to the CAAT pension plan, where we will prepare a formal quote for you. So again, you don't need to make any decisions when you're running your estimate. Once we send you your quote in the mail, you're going to review it. You may want to sit down with a financial advisor if you choose to. This is where you decide whether or not you want to make the purchase. If you do decide on making the purchase, what's going to happen is we'll simply update your record, and we're going to confirm your purchase with a letter in May. DBplus.ca is our website. This is where you can access all of our tools. Or if you have any questions whatsoever, you can call our toll-free number. And here it is here, 416-673-9000. You want to send us an email, it's info@dbplus.ca. and that's if you want to send us anything in writing. So what I'm going to do right now is I'm going to pass it over to Bill and see if there are any questions that have come in with regards to purchases.
Great, thanks, Steve. So just a reminder, if you have questions for Steve today on any of the information we covered, please type it in the questions box, and we can answer those questions for you this afternoon. So there are a couple of questions we have in the queue. So the first question is, could you explain how survivor benefits work?
Yes. Survivor benefits, there are two options at the CAAT pension plan. We have our normal form of survivor pension, which is a joint survivor 60% pension. Okay, we also have a joint survivor 75% option. Okay, so all this means is that if you have a spouse, whether that's a legal spouse, common law spouse, same-sex spouse, if you were to pass away in retirement, the pension goes on. So this is a decision that you would make, or the member would make at retirement, on which option they choose. If they choose the 60% option, all that means is 60% of the pension that they were receiving will be paid to their spouse for the rest of his or her lifetime. It would also receive inflation adjustment increases the same way as the member would. Okay, if they wanted to choose the 75% option, they could do that as well. And in this case, they're providing to give their spouse a little bit more. Okay, but with the 60% option, that's called a no-cost survivor pension. So what that means is the cost is built in. A lot of pension plans, as a result of a member choosing that joint survivor option, that may reduce the member's pension. Well, with CAAT, because that cost is built in, there's no cost to you as the member. That joint survivor 60 is our normal form. Your pension will not go down if you choose that option.
Okay, thanks, Steve. Next question is, for employer identification, do we use our agency name or Catholic Charities?
So you would probably use your Catholic Charities name, because there are a number of different agencies under the Catholic Charities. As you saw when we went through the tool, in the drop-down, I used Catholic Charities, Archdiocese of Toronto. You would just click that, and then you can use the tool.
Can I add that the purchase calculation is not based on the agency schedule, so it's not impacted in this case?
Yeah, that's a good point, Andrea. If you happen to be going on our website, some sections of the website, for example, if you're looking at contributions, those are more specific to agencies, so you can see different contribution rates there. But when you're using the tool, you're always going to see in the drop-down what your options are.
So the next question we have is, let me just get it here. So for those over age 60, there's seems to be no point in purchasing. Is this correct?
Not necessarily the case. At the end of the day, you do want to remember this is your own personal decision. You have the option to make a purchase. You don't need to, but that's the idea of using our tools, jumping on our website, and seeing whether or not it makes sense for you. I would highly suggest or recommend that you do run a pension estimate. We also have a purchase tool built into our pension estimator tool as well. Today we went through the purchase tool, which incorporates the 18% maximum. I have heard of examples in the past where people who are close to 65 had made those purchases. So yes, although you can purchase less pension the closer you are to normal retirement age, it still could be beneficial to you depending on your own individual circumstance. So again, that's more of a personal question, but the way to get those answers is jump on our website and check out the numbers yourself.
Great. The next question we have is, can pension be purchased with monies that you have in a tax-sheltered vehicle, like an RRSP, that is not from a CAAT employer?
Yes, exactly. If you have personal RRSPs, they can be used. So that's a great question. So again, step one would be running the estimate and developing the form. And those funds, it can come from your personal RRSPs. The key thing is that it is tied to employment. And when I say that, I mean the purchase is. You cannot just give us personal RRSPs. It needs to be tied to employment. So somewhere where you previously worked. So whether that's the Catholic Charities, whether that's for another company in the past, if it's tied to employment, then yes, those funds can come from registered retirement tax-sheltered vehicles.
So can you describe what happens to employees who are part of DC prior to joining? Does their contribution automatically get added, or will they have to make a purchase contribution?
So we're talking about purchases today. So as of Jan 1, 2020, you'll now be contributing under your pension contribution rate under the Catholic Charities. If you wish to make a purchase in respect of your prior employment, this is a member-driven process where you'll have to look at your own personal situation. So for purchases, which is what we're talking about today, you want to explore your options, think about your past employment. You have the option, if you have a DC account balance, to use those funds in your DC account balance to make a purchase. You just may not be able to do it right away because that DC fund must be wound up first. So you may have to wait a few months before that happens. Once it does, you would receive options, and then you can go from there and decide whether you'd like to move those DC funds into the CAAT pension plan.
But it will not happen automatically.
No, it will not happen automatically.
Okay. So the next question we have is, when using the pension purchase tool, can we provide pension statements and get an accurate quote of benefits?
I think the question was, yeah, you can. You can use, it's a great resource using your pension statement. You wouldn't receive a pension statement right off the bat now, but it is a great resource. A lot of our members in the CAAT plan do use their previous year statements to plug in their numbers. You have a couple of options. You can use your statement. You can go to your employer, whatever option suits your needs.
So the pension statement will give you the total amount, and so that will be the contribution amount you can use to make those additional purchases. That's a great idea.
So there's a question regarding, I guess, the pension adjustment factor. So curious as to why there is a reduction for older contributors when there isn't for normal pension contributions.
Yeah, so the logic is quite simple, really, when you think about it. The closer you are to retirement, yes, the less pension you can purchase. And the reason is the younger you are, if you are going to pay us a contribution for a purchase, the further you are from 65, now we have time to take that money, invest it, and make it grow over that period of time. The closer a member is to retirement, now we don't have that time to accept their contribution, invest it, make it grow, because they're going to be retiring very, very soon. So the closer you are to retirement simply means that that member is going to most likely retire soon. So we have to turn that amount into a lifetime pension. And so that could take some time, but that's really the logic behind it.
Okay. So we have a question, I think this is regarding the federal pension plan. I'm just going to read it out. Maybe you might know the terminology that's being referred to here. But it's the question is, can SDB from federal government qualify to purchase DBplus pension? And the second part of the question is, and what happens if participants of DBplus leave the Catholic Charities and move to a different employer? Can the service, I guess the pension purchase, be transferred to the new pension plan?
Yeah, so I'll kind of leave the federal question for now. I'll jump to question number 2. Unfortunately, I'm sorry, I apologize, I don't know the answer to that, but you can send that SDP question to our info@dbplus.ca. But yes, there is portability in the plan, which means that if you were to leave your current employer, the benefit you've earned is yours. Okay, so in other words, you're going to have options on what you want to do with that benefit depending on your age when you do leave. Because if you're of retirement age, which is over the age of 50, you could receive a monthly pension, you could defer your pension, you have those other options. You could transfer it out to another pension plan. So the option of moving your pension benefit to another plan is there. You can port it over, as long as that other plan allows it and has a pension plan. If you are under the age of 48, it's considered a termination or a resignation. And the reason why is because retirement age starts in DBplus at age 50. So if you're under the age of 48 and you were to leave your employer, Just keep in mind there's a provision in the plan, and it's like a 24-month waiting period before you can access what's called your commuted value. So that's the lump sum value of your pension benefit. And this option really is just there. This is just for awareness, but that lump sum commuted value, some people decide to take that, invest it on their own. You have that option to do that, but you need to be under the age of 48 to do that. Once you're over the age of 48, that option to take your benefit with you is no longer there. But you could still transfer your benefit after the age of 48 to another pension plan if they have a registered pension plan.
Okay, so just I guess a follow-up question to a question we had earlier regarding the employer identification. So I think the question they were trying to ask is for the application form for the pension purchase, do we put the agency name or the Catholic Charities name? So
on the application form, I would say maybe put both just to be safe, as this is a relatively new process. Put the Catholic Charities and the agency name just to be safe.
So next question we have is, does the 18% contribution limit include our combined RSP and pension contributions, or can we contribute 18% from each?
So it's really 18% of your T4 earnings. Okay, so it's really of your earnings in respect of the period that you're purchasing. Andrea, you may want to add to this. Yeah.
Okay, so the 18, so when making a purchase, the form would indicate those period of employment. And so the 18% will limit your earnings for those period of employment. That's the maximum amount you can use to make a pension purchase on the DBplus. I hope that's inclusive, but it doesn't impact your RSP rule because you transferred it from a tax shelter vehicle into another tax shelter vehicle.
Okay, so the next question we have is, if you are a contract employee, will any purchasing or any purchase that you make stay within the plan and continue to grow until retirement if you are no longer with the organization?
The short answer is yes, depending again on what you're doing and what you're doing with your benefit. But yeah, if you're a contract employee, in other words, you're part-time, and you are making contributions into the plan, and you want to make that purchase will go towards your retirement. So the answer is yes.
So a question regarding the survivor benefit. If a previous employer's pension plan does not have a survivor benefit, does that affect the purchase amount into the CAAT DBplus plan?
It does not. It doesn't matter the other provisions of the other plan whatsoever. You're now under DBplus, under the CAAT pension plan. So with those provisions, when we're talking about a purchase, what we really need from the other employer is for them, sometimes earnings information, so we can make the calculation on our end. So the survivor benefit doesn't really factor in to a purchase at all.
Okay, so a question we have is, if I don't have any RSPs currently and I go and purchase some RSPs tomorrow, can I buy back pension service or pension from this RSP that I purchased?
Yeah, it's a common workaround as long as you have the RRSP room. Again, we can't give those financial advice, but it's a workaround that many people use. If they have the room, they can purchase an RSP. And then when they make that purchase, though, again, remember, it needs to be tied to employment. So they can't just give us an RSP. As long as it's tied to employment, we go through the process, they go through the forms, and yes, they can make the purchase as long as those funds come from the RSP.
Can we file our contributions for income tax purposes?
No. So contributions are already tax deductible. Okay, so they're already, as I said earlier, they're very, very similar to RSP contributions. They're deducted before any other deductions get taken off. So when you receive your T4, because you belong now to a registered pension plan, there's a little box there. Well, it will have your RSP, sorry, not your RSP. It will have your contributions that you've made to the CAAT pension plan on your T4.
Okay, so
Sorry, I was just trying to understand the question. So is it the, can you repeat it again for me?
sorry, I've already moved the question over to our archive.
It was more, are the contributions, can you claim them on income tax?
Yeah, so is it the contribution on the DBplus or is the contribution used to buy a purchase?
I believe it's for the purchase, yeah.
Okay, yeah, so the contribution for the purchase already been taxed, and that's why it has to come from a tax shelter vehicle. So it's already been incorporated.
Right, so there'd be no tax implications. That's why it needs to come from like an RRSP or a DPSP.
Okay, so we just have a few more questions here. So what does it mean that an RRSP is tied to employment?
Not the RSP is tied to employment. Really, when we're looking at pension purchases, you know, a member cannot just give us RSPs and say, add this to my pension. It needs to be for a period in respect of prior employment. So if they work somewhere in the past, that's what we mean when we say that. If they work somewhere in their past that have a pension plan, then let's say, for example, they had a lira sitting in respect of their benefit. So A, you know, it's related to their employment because they had a benefit with another previous employer. So we need someone to sign off the form to say, yes, this person did work for another pension plan in the past. And B, when they make the purchase, it's where the funds come from. They have to come from registered tax shelter vehicle. So Part A or Part 1, as I was describing it, the purchase needs to be tied or needs to be related to another employer in terms of retirement savings.
Okay, so we have a couple more questions. If someone leaves their job at Catholic Charities and works for another organization, can they continue to contribute to the pension plan?
No, unless they go to a CAAT participating employer. So if they go to another CAAT employer, and if you want a list of all our CAAT participating employers, you can go to our website for that. But if you go to a non-CAAT participating employer, no, you continue to make contributions. You could, however, defer your benefit and leave it with the CAAT pension plan while you go off and work somewhere else. It wouldn't be growing necessarily. It would be growing slightly in inflation adjustments year over year. So it would be slightly increasing, but you wouldn't be contributing to it. So the growth would be minimal.
Okay, and then just for clarity, if you were part of the DC contribution prior to January 2020, our current contributions would be like a new participant in the plan.
Yes, your new contributions, if you refer to the contribution schedule on the website, you can see what your contributions are specifically. But I'm not quite sure I understand that question, to be honest.
Yeah, so okay, so for the DC plan member, they would have received a notice of letter earlier on, ended last year, and in that letter you would have how it would impact you. So as of December 31st, 2019, you would cease contribution in that defined contribution pension plan. And as of January 1st, 2020, based on the schedule for the participating agency, you would start contribution in DBplus. And yes, it is like a new contribution, a new plan.
Yeah, so all the new contributions that you're making are coming directly to the CAAT pension plan.
Okay, so DBplus pensions are not coordinated with CPP, so it does not reduce your CPP pension, unlike say the teacher's pension plan. Is that correct?
So yeah, there are some defined benefit pension plans where their formula are incorporated or tied to CPP. Our formula is not tied to CPP, so you are correct. But your CPP is another source of retirement income that you have in retirement. So not only do you have your employer pension, you also have your Canada pension plan as well. You also have your old age security, so both CPP and OAS, and then you also have your personal savings on top of that. But in terms of the formula, no, we are not incorporated with CPP. It's a separate pension.
Okay, so we have one question left. It's if an employee is 67 years old and previously contributed to the DC plan with the same employer, can this employee still purchase from the DC plan?
Yeah, they can. So you can purchase right up until age 70. So because you're going to have a DC account balance in your previous plan, once that plan winds up, you can use that DC balance to purchase more pension in DBplus. So the idea is you want to find out, maybe keep in contact with your employer on when that will happen, and when it does, you want to go to the tool, fill out the form, send it to your employer, and we can do that calculation for you, and then at that point you can make your decision.
So we just had another question regarding the DC. Can we purchase the whole period of time you were in the DC contribution plan?
So the idea with DBplus is you're purchasing pension. So as long as you don't exceed those maximum ITA limits, the 18%, then you would be fine. So you would have to do that test that we went through in the demo today. So you'd have to figure out how many years were you in the DC plan, tally up your earnings for that particular period, and then as we saw today during the demo, that's going to give you a maximum purchase amount. If your account balance in your DC account is less than that, then you can purchase the entire amount.
Okay, that's all the questions we have in the queue. Maybe I'll just wait another second just to see if anyone else is typing a question. And again, if you have any questions after today's session, you can send us an email at info@dbplus.ca, or you can contact us at the phone numbers that are shown on the slide. So I don't think we have any more questions, so I'll just pass it over to Steve to conclude the session.
All right, well, I do definitely want to thank everyone who's listening in and joining us today for the webinar. I want to extend my thanks to the Catholic Charities. Ganesh, thanks for being here. And yeah, if you have any further questions whatsoever, if your question didn't get answered today, just send us an email, give us a call, and we'll get back to you as soon as we can. So have a great afternoon, everyone.
Thank you.
Thank you.